Let's dive right in, first of all, to that terrible tax surprise, these three terrible tax surprises that could needlessly rob you of your hard-earned savings. What is that first tax trap we need to talk about and be concerned about, Matt?
Really, so Michael, the first tax trap is not having a plan or strategy in place for pulling money out of your IRA or 401k in retirement. And this can be a big problem, not because there's anything wrong with taking your money out. The problem is that if you don't do it right, if it's not a well-coordinated situation where when you're pulling this money out, it's timed properly, you could needlessly trigger a much bigger tax bill and a number of other problems can follow. See, here's the thing. The government makes it really easy for you to contribute money to your IRA or 401k. Your contributions are tax-free and they can be made automatically. And you can even invest this money and grow it without paying any taxes at all. That all sounds great, but when you start withdrawing money from these accounts in retirement, that's when things get complicated. In fact, it's so complicated, it's almost as if the system is designed to trip you up. So even sophisticated investors needlessly trigger massive tax bills that could cost them a small fortune in retirement.
That doesn't sound good, and that's not good either, Matt.
And it isn't, Michael. And in reality, I'm not the only one that's saying this. The Motley Fool said, if you're not careful, you can ruin a lifetime of successful saving when it comes time to withdraw money from your nest egg. Most people don't realize this, but how and when you withdraw this money from your IRA and 401k makes all the difference, because the timing of your withdrawals could have a huge impact on how much you end up paying in taxes versus how much you keep in your pocket.
Matt, why is that?
Well, Michael, really, the withdrawals from your IRA and 401ks are taxed as ordinary income. And guess what? Your Social Security benefits and other investment income, including dividends, real estate, are also taxed as ordinary income. And all of these income sources, when it's all added up together, you end up paying a lot of income taxes on all of this money, even if you didn't work one single hour all year long. So the timing of when you make withdrawals from your IRA and 401k, and when you even file for Social Security is pretty critical.
Timing, the essence of everything right here, makes so much sense, Matt.
Well, Michael, we want to help clients plan for this because one decision has a domino effect. And if you're not being very careful about it, one wrong move could force you into a higher tax bracket. And it could even, in a worst case scenario, double your Medicare premiums. So the money that you were counting on to help for your retirement could end up being a lot less than you thought it was going to be, unless you make a plan now to keep the cash for yourself.
And Matt, a lot of people are under the delusion, if you will, that their taxes are going to go down in retirement, but that's not necessarily true, right?
Definitely not necessarily true. A lot of people make this mistake, though. They assume they'll be paying fewer taxes in retirement because they're no longer working for a paycheck. I get that, but unfortunately, that won't be the case for many retired Americans. A lot of people don't consider how taxes change as they age. Deductions like mortgage interest and claiming children as dependents, those things disappear. You also have to account for RMDs, required minimum distributions, which none of us had to deal with before. But when you turn 73, the government forces you to withdraw a certain percentage of money from your IRA and 401k. And you have to withdraw money every single year until you pass away or until the account is 100% depleted. And you have to make these withdrawals, regardless if you need the money or not, or whether the stock market is up or is down. Now, RMDs may not sound like a big deal on the surface, but they can be really bad to force your hand in the wrong way.
How so, Matt?
Well, imagine this scenario, Michael, where you're 75 years old, you started taking RMDs, but then there's trouble in the stock market and your portfolio is down. RMDs could force you to break the cardinal sin of investing, which is to sell your investments at a loss. And there's no way to get that money back again. To make matters worse, when you sell these investments, that income could push you into a higher tax bracket. So you wind up with a higher tax bill and even less money in your pocket. It's like a snowball effect. So you really have to be careful here.
Yeah, it makes sense. So, Matt, how can someone navigate RMDs and avoid overpaying taxes on a 401k or an IRA?
Well, Michael, it really comes down to the difference between tax preparation versus tax planning. Most people are familiar with tax preparation. This is when you prepare and file your taxes every year with the help of an accountant or CPA. But aside from some obvious deductions that you might save a few dollars, at this point, what's done is done. You're just looking and reporting history. So tax planning is a totally different situation here. Here, you're looking forward, not backward. And you're using the tax code to identify strategies that could help you potentially save a lot of money on your taxes for the rest of your life. And if you take advantage of some simple tax planning strategies, the savings could be significant. Even in some cases, it's not uncommon for us to uncover tens of thousands of dollars, or in some cases, hundreds of thousands of dollars in tax savings for our clients.
So, Matt, it sounds like smart tax planning can help us, avoid a big tax hit in our retirement savings. So what can viewers do to get a jump on this tax planning?
That's a very awesome question, Michael. One of the most important things to nail down is what's going to happen with the money in your IRA or 401k. Most people think of this money as being 100% theirs, but they forget that the IRS could take a big chunk of this every time they make a withdrawal in retirement. And with RMDs, they will force you to take this money out anyways. So your tax bills could end up being a lot bigger than you thought. So here's the good news, though. If you take advantage of some simple tax planning strategies now, you could save a small fortune in retirement. And that's why we'd like to offer a free customized retirement tax savings analysis just for the viewers of the show today. This is a proven process that shows you how much money you could end up saving in taxes when you retire.
Well, it's fascinating, Matt. Exactly how does that work?
Let me explain it real quick then. Michael, we make it really simple. First, we get some basic information from you, and then we find the tax saving strategies that are best suited for your specific situation. And finally, we show you exactly how much money these strategies could save you. Now, most advisors charge thousands of dollars for a customized tax analysis like this, but we'll walk you through this proven process and we won't charge you a dime for it.
Matt, so much great information here. Thank you so much for that. So, want to find out how much you could save in taxes when you retire? Just request your free customized retirement tax saving analysis from TRUNorth Advisors.